Hi, I'm David Huff, CPA with DW Huff Consulting, where we help small business owners build, grow, and enjoy their wealth. Reason for this cast today here is we're going to talk a little bit about employee retention tax credit and some of the updates that have kind of come to our attention here. So, as you know, this credit program has been going on for a while now, and it's kind of evolved somewhat. There's been updates by IRS and various other changes along the way. So it's probably a good time to revisit everything. It's been probably about a year since we've done our last seminar on this topic. So today we're going to go back and just recap what the employee retention credit is. There also are some updates to the IRS frequently asked questions. So towards the end of it, we'll go through some of those updated bits of information that they have shared with us. Observations based on what we've seen here in our practice. We've processed quite a few of these, and a few things that may be useful to you based on our experience there. And we'll just go over again the qualified eligible businesses and qualified wages and limitations, and of course we'll talk a little bit about actually filing the 941X, which is the form that's required to get your money. So just real quick about my firm here. I'm a CPA, got a master's in tax as well. Founded this business kind of recently, but I've been in practice since 1997 in various shapes and forms of other CPA firms. So been around the block a bit here, and this definitely that experience has definitely come in handy with dealing with this. So but anyway, so this is at July 29th, 2023 update of things, and we're going to, I guess, start with an overview of the benefits here. So so basically what it is it's a retention credit, so federal credit that's available. And the intention here was to have it encourage business owners to keep their employees on payroll and minimize the number of employees filing for unemployment benefits. So that was the plan, which is kind of odd because so many things were passed kind of after the fact. So if you'd already had to lay off employees, it wouldn't have you wouldn't have known about this incentive possibly. But that's kind of the general explanation of it. I guess before I get into it too much more too, I'd like to mention, based on some other experience on another prior thing that was like this that generated a lot of refunds for taxpayers. And that was going back to our experience with the Hurricane Katrina casualty losses. So, and the reason why I mention this is because you're going to see a lot of advertisements out there, and they're going to be touting this $26,000 per employee, and they're going to make it sound like it's very easy and a very lucrative gold mine type thing, but that's not the case. So we're going to go over some of the details of how the credit is calculated and all, but there was an example of something like this in the past. So back when the Hurricane Katrina hit our area, so if you don't know, we're a South Louisiana based CPA firm right outside of New Orleans. So Katrina had a big effect, and there were people at the time that were just making these extremely aggressive casualty loss calculations, right? So as the CPAs and myself and other colleagues, they were calculating things the proper way. Taxpayers were seeing, $4,000 or $5,000 refund, and they lost a lot of money because there was, total loss on the property. But what you're gonna find is that a lot of these IRS refund provisions weren't really all that generous. And there was another practitioner, so not a CPA, but a taxpayer in town, who was filing these crazily high inflated claims. These people were getting $25,000 and $30,000 refunds, and we were although other, I guess, more reputable practitioners were taking some heat for that, because our people were getting smaller refunds, and how could this other person down the street who's doing thousands more returns than anybody in town can get these 5-figure refunds for these casualty losses. Well, as time went on, IRS saw it, started challenging these refunds, asking for documentation that didn't in any way, shape, or form back up the amount of refunds, and it all blew up, and it ended very badly for these taxpayers who were chasing this gold mine basically. And I guess another side note here is that once these things got disallowed and they found out there was one particular tax preparer that was doing it, they basically went into their whole database of filed returns and disallowed every single casualty loss in that database. So every single person in that database now had all this extra work to go back and improve their casualties, and they were very aggressive in disallowing casualties, so it made it much, much harder. So that's why we're going to go over a little bit about how you qualify, which periods qualify, which wages need to be excluded. We really want to make sure that we're claiming it in the proper amount, and it might not be $26,000 per employee. In fact, we'll talk a little bit more about our experience there, but you're gonna get some refund, I think, in most cases, but definitely be careful. So the basics for 2020, that version of the credit is worth 50% of eligible wages, and those wages can't exceed $10,000 per employee. So we'll talk a little bit more about exclusions for PPP and that kind of thing, but 2020, $5,000 is the maximum per employee. And we do need to talk about reducing those eligible wages by PPP forgiveness. So the payroll protection plan, a lot of small businesses qualify for that and had forgiveness of those PPP loans, if you remember. So that complicates the calculation somewhat. And also don't forget about health insurance benefits. So if you find yourself having a case where a lot of employees don't fully hit this maximum credit eligible wage amount, note that health insurance benefits paid by a company are also includable. So for 2021, the credit is much higher. So now we are talking about it's still going to be a $10,000 eligible wage limit, but that limit is on a per quarter basis, and that calculation is 70% of the qualified wages. So now we're talking about possibility of $7,000 per employee per quarter, so 21 grand per employee. That's where you're hearing this $26,000 claim because of those limitations. So the rules are a little bit different there, and I guess I'll also note here that if you are a qualified recovery startup, that's a completely different set of rules, right? So and that's going to affect the business who started operations after February 15th of 2020, and we'll definitely talk about that in more detail. But basically, the first 3 quarters of 2021 are eligible for your ordinary situation here, where you've been in operation for a couple of years and been around for a while, and a qualified recovery startup could only get the 3rd and 4th quarters, because obviously if you started in 2020, you're not going to have these revenue drops and some of the other possibilities. All right, so one of the myths versus the reality here is that we see this a lot on television ads. So just recently, as I was recording this, I'm watching, and this advertisement keeps popping up on one of the channels, and they keep mentioning this $26,000 per employee. Now, granted, this one they're saying that is up to $26,000, but I think a lot of people just hear $26,000 and think that's what I'm getting per employee, and that's not the case. So what we have found, and we've done a couple hundred of these so far, and got plenty more in the pipeline, but the reality of it is that it's not $26,000 per employee. What we're finding, due to the complications of this calculation here, that we have about 5% of our businesses that have come to us for an analysis don't qualify at all. So they could have been an essential business, and just the way the rules work, if they made the same amount of money as they did in prior years, or even increased in some cases, and didn't have all these government shutdown effects of their business, there's some businesses that just don't qualify for any of it. There's just no way, shape, or form to make them eligible. So, but that's been a very small amount. So that's why I guess I don't want to discourage anybody from having an analysis done, because just when you look at the rules and the different time overlaps and those government orders, I'm just finding that most everybody's going to qualify for at least some amount of money. So it's definitely worth your time. Don't ignore this because you think it's too complicated. Get somebody to help you analyze it if you are still up in the air about your qualification. But on the flip side of that, we've only seen probably about 20% that qualify for all 6 quarters. So somewhere in between 26,000 and 0 is what you could expect to receive, I would think, and that's been our experience. So I don't know if others have seen different statistics, but that's what we see, and it's definitely as you see with our numbers here, more common that you're going to qualify for some quarters and not others, and $26,000 per employee is probably not happening. So with that, we'll go over the calculation overview here. So we do have other parts on our website that go into tremendously more detail, but let's just talk about how you get there. So starting off, there's three different ways, right? So you got the revenue drop, government shutdown, or qualified recovery startups. That's the general categories, right? That could possibly affect you. I like to look at the revenue drop first, because if you qualify based on a drop in revenue, that's the easiest way. If you qualify in a quarter, the whole quarter's open, so there's no having to look for start and stop dates on government orders. It's easy. It's easy to prove. You show your QuickBooks reports to somebody, and it's just clean and easy, and that's what we like, right? So for 2020, they want you to be able to demonstrate you had a 50% drop in revenue, or for 2021, they want you to demonstrate a 20% drop in revenue. So easy. Revenue is your top line sales number. So they don't care about gross profit, they don't care about net income. Gross revenue is what we're talking about here. So if you qualify on those revenue drops, that's great. And you compare it to the same quarter in 2019. So first quarter 2020 compared to first quarter 19, second quarter 2020 compared to the second quarter of 19, and so on. So that's the general starting point. But there is another complication. There is an alternate method available for 2021. So 2021 allows you to look at the prior quarter's numbers, and if those qualify, and you're talking. So an example here would be if I'm trying to determine my eligibility for the first quarter of 2021, let's say, and let's say 2021 numbers don't meet the ordinary 20% decrease rule. You can look at the fourth quarter of 20, and that would unlock the first quarter of 21. So a similar thing could happen in the second quarter of 2021. You go back and look at the first quarter of 2021. If that quarter qualified, then second quarter also qualifies. So it opens up a little more possibility there for qualification. But that's my second step in the analysis. So like the easy way first, where you just hit the numbers and that's that. But if not, then we have this other alternative method out there that's available that affects just 2021. And if you don't meet any of the revenue drop criteria, then we have to go to the fact that the business may have been subject to a full or partial suspension caused by a government order. So that's much more, I guess, subjective and can be more difficult to prove, I guess. For one, it's not easy to always find these government orders, 2 years after the fact. So now we're way into the future here. Not always easy to go back and find an official act. Sometimes there's a lot of a misunderstanding. Something that was a suggestion of the Department of Health may not have risen to the level of a government shutdown. So a lot of things companies were doing may not have actually met the criteria. So it takes some analysis to really figure out what exactly qualifies there. So we don't like that as much. And then if you're qualified recovery startup, I guess that'd be another twist. So if you didn't start business until February 16th of 2020, then you qualify under those rules. And those we like because that unlocks the third and the fourth quarter of 2021. And there is a limitation of only $50,000 per quarter, so a couple little twists and turns there. But there's a way to qualify for some money there if you were a new company. So we'll go into a little more detail in a minute here, but that's the general rule there. And just talk a little bit more about this full or partial shutdown due to a government mandate. So it's got to be a mandate. It can't be any kind of voluntary method. Anything that you've done as a voluntary measure does not count. It's got to be government telling you can't do something. It could be state or local. So in our area here in New Orleans, the state had one set of guidelines, but at least one of our parishes here, parish is the equivalent to a county for those who aren't from here, those parishes in some cases had more restrictive requirements, and that helps you. So Orleans Parish had more restrictive social distancing rules, and the restaurants and bars had some tighter restrictions for a while. So you may not have made it under the state analysis, but the local authorities could have affected you. So we've got to be aware of that when we're analyzing all this information here. And has there been a more than nominal effect on at least one segment of your business? So we got that going on. So that nominal effect. So if it didn't really cause you, so if you missed the revenue drop, it still has to be a significant effect on the business. And the example that I saw in a training continuing education seminar a while back was they gave the Burger King example. This is a good way, I think, to understand. So Burger King has a drive-through and a dine-in. Well, a lot of these social distancing mandates and capacity restrictions cause these Burger Kings to shut down their indoor dining. So when people came up and they were looking for the Whopper, if they couldn't go in and get it, they just go to the drive-thru. So the overall business didn't decrease, but the overall indoor dining did decrease. So that caused them to be considered to have been passing the test of having more than nominal effect. And I think if you looked at their net income, yeah, they may have had the same gross sales, but I'm sure there was some extra cleaning and extra work involved with having it all take place through the drive-thru. So that would tend to indicate the fact that it was definitely more than a nominal effect. So that's an example there. Another commonly misunderstood rule is this last item here, the supply chain restriction versus a slowdown. So let's use an example of a farm, let's say. So if you were a beef processor, let's say, and let's just say something was going on and the government came in and said, we are not allowing any slaughterhouses to operate, and no beef can be shipped to any beef processing plants, right? So those beef processing plants who can't receive their beef because they cut down this agricultural restriction, that is an example of a supply chain restriction that is government mandated. So these people could not get this product at all because of this shutdown. That's different from a global supply chain slowdown. We saw a lot of that too. Remember, thinking back a little ways, there was these container ships off the coast of California and other places that were just sitting there because they couldn't be unloaded. Labor restriction, whatever it was, but that was not a government mandate. That was just an overall market effect of whatever was going on at the time with the laborers and the truck drivers and everything else that was just making it impossible to load these ships, right? So that same beef processing plant, may have not been able to receive their shipments due to that, and that would not affect them. So you had to show that somehow the government controlling one of your suppliers affected your supply chain. So commonly misunderstood section there, and it's as there's most everything, I think a lot of people will look at these bullet points and say, oh, supply chain, okay, yeah, my stuff was sitting on a container ship and it wasn't unloaded, but that's not going to cut it for a COVID-19 related retention credit. So, and talk a little bit more about a qualified recovery startup. So we talked a little bit about earlier, they have to have started operations after February 15th. But there's also another limitation that you can't have annual gross receipts that exceed $1 million. So a large startup would not qualify based on revenue, but below $1 million they can. And that maximum credit is $50,000 for the third and fourth quarters of 2021. So for that fourth quarter of 2021, the only way available now to get any employee retention tax credit for that quarter is if you are a qualified recovery startup. And that was something dependent on which rules you're looking at, because initially all 4 quarters of 2021 were allowed, and that changed. So as time went on a little bit, that fourth quarter was removed from everything, removed from the possibilities, and except for the recovery startup company. So you got to be careful. And this is another tricky part too, depending on which, what Google search pulls up, what document. Some of the stuff that you may pull up could possibly simply be outdated, and that can also cause you some problems with claiming your credit. So once we kind of determine our eligible period, so once we've looked at and we determined whether it's a government shutdown or a wage, whatever it is, then we can go into a little more about calculation of which wage is going to qualify. So obviously salary counts, right? Hourly, whatever. But another side note is that the healthcare expenses can be added. So if you find yourself in a situation where you're not maximizing that full $10,000 of eligible wages, keep in mind that if your company pays for anybody's healthcare expense, that can be added to everything, and possibly get them up, over those thresholds. So keep that in mind. And then another, I guess, bad part of it is that our owners and owners' relatives have to be excluded. So anybody that has a more than 50% ownership interest in the company has to be excluded, as well as their spouse, parents, children, sister and brother, and cousins. So anybody related to that owner who owns more than 50% has to be excluded. So that's been kind of a much debated and argued about topic, but that's the way the rule is now, and until or if somebody changes it, but we don't expect to see any changes to that. So owners got to take them out. Also, payroll protection plan loan forgiveness comes into play, as those amounts can't be used. So what they mean is, if you had $100,000 worth of PPP wages and you qualified for a certain quarter, you have to look at those PPP forgiven amounts and subtract that from the wages that you're going to use for the eligibility calculation. So sometimes the way the PPP works out, you would have been eligible. PPP wiped out your eligible wages and reduces it down to zero. And that sometimes that has caused some unpleasant surprises. But we do need to factor in that, because you're not allowed to double dip. So you can have gotten PPP forgiveness and still get your employee retention credit, but it's only in wages that exceed your PPP forgiveness. And there is a kind of way to structure that, because PPP forgiveness covers a certain time period. So there is some possibility there for making your PPP forgiveness affect a quarter that's not also affecting a quarter where you qualified for the credit. So you have some flexibility with how you allocate that, and there's some workbooks will show you if you want to learn more about the details of that, but just make sure we're not double dipping. And our limitations here. So I think we mentioned it before, but the wages and healthcare expense, so it's still $10,000 for the whole year of 2020 and $10,000 per quarter for those possible quarters in 2021. So you don't get an extra amount for the healthcare expenses. It's the healthcare and wages get all combined together, and whatever that number is, it's either that number or 10,000. Whatever's the smaller of the two numbers is what can possibly be utilized. The IRS has recently updated their frequently asked questions, and that's been helpful, because a lot of these things have been coming up in our conversations with clients, and I think they're doing a lot more auditing of these things now. So these are things that have come up regularly enough where it generated 13 new facts. So the first one here, I think we already talked about this, is every business eligible? Obviously no, right? Because there's all kind of reasons why, but yeah, so be careful when you're watching the ads and they're getting the spam faxes and emails and everything else, because not everybody's going to qualify. Can't stress that enough. But like I said before, we do see that most people qualify for at least something. All right, but who's eligible? So be careful there about who is an eligible employer. So we talked a little bit about the qualifications, whether they have a full shutdown, decrease in revenue, or qualified startup. But also be careful about the type of business. So on this other question, they talk a little bit more about some specifics of people who think they're employers, but they're not, right? So if you're just an employee and you work somewhere, you don't get it. This is only for people who pay others a salary and issue a W-2 at the end of the year. So retirees, employees, any kind of individual taxpayer who's not a business owner, there's no way for you to qualify for this employee retention tax credit. But some other things that I guess might not be as cut and dry is household employers. So there are people who have butlers and that sort of thing, and house staff, in-house home health, and those people are not considered to be employees. So household help, even though those type of people who have to pay them might have to issue them a 1099 and might do payroll taxes and all that stuff, that is not considered to be an employer for purposes of this. And naturally, if you didn't pay anybody, it doesn't count. So I don't know how that's even a point of being confused, but I guess it came up on some of the audits, so there we are. And government agencies also don't qualify. So that's a side note too. In a different webinar I attended last week, some IRS people from their fraud division talked a little bit about what they're seeing, and there's still a lot of fraud here. So not only is there a wide range of just misunderstanding, but blatant fraud. They gave some examples of companies who didn't actually issue W-2s, who just, I guess they just made up 941s and sent them in and were trying to get the claim. And so they are going back and checking those things to make sure that you were legitimately an employer who paid taxes and paid employees and made W-2 filings and all that kind of stuff. So I think they're very, very busy here with just to make sure that the right amount of money is being dispersed for anybody who makes a claim. So what kind of government orders qualify? So it's got to be a government order from the mayor, the governor, somebody like that. State's emergency organization would help you. And I guess to expand a little bit upon that, So an emergency proclamation that requires residents to stay at home could possibly help you. And so it's, even though you might have still showed up for work, if the other people couldn't come to work, it could help you. So it's another complicating factor. An order that requires you to close for cleaning and disinfecting. So we had that affect a client who actually did make the same amount of money, but it took, an 8-hour day ended up being a 12-hour day, because in their municipality they had a shutdown every 4 hours for cleaning, and that disinfecting process was pretty detailed. Took them like an hour and a half, 2 hours to get it done. So that 8-hour day was not an 8-hour day anymore, because at least twice a day they were having to meet this requirement for cleaning. So it actually qualified. And I think even though you had that gross revenue side, net income definitely was a lot less, because it's extra time that was involved here. And so that's another thing to keep in mind. So if you were forced to clean, so now it's not, you couldn't have just chosen to clean. You had to have a government order like this one company did, and there's a possibility that could unlock some time periods for you. And can you rely on a recommendation or a bulletin? And the answer to that obviously is no, because some of these recommendations and best practice suggestions don't meet the requirement. They don't rise to the level of a government mandate. So got to be careful which rules you're looking at when you decided to shut your business down. So what does it mean to be fully or partially suspended? So that's another area that's been very, very tricky, right? So assuming the government mandate did affect you, there's some other considerations here. So if all your employees are able to telework, that doesn't help you. So if you were an accounting firm, for example, and everybody just worked from home, that doesn't help you. But if the limitation affected your ability to meet with people in person, so if you were a type of entity where you had to meet with people, just the fact that you could do your paperwork at home does, that you could still possibly qualify, because you couldn't meet with the actual people. It's just because you could do some stuff at home, you couldn't do your full job. Getting into this facts and circumstance subjective analysis that we really hate here, because there's so many twists and turns. But so it doesn't completely rule you out, but it probably does. And if your customers are affected by the stay-at-home order, that doesn't necessarily mean that you were affected, right? Because your people could have still shown up to work every day, but nobody was coming in because the other non-essential people couldn't come to your business. So we don't like that scenario either. And of course, if you're voluntarily closed, so if you just did the right thing because you didn't want to expose your people to the public and the possibility of contracting the virus, that doesn't help you. All right, so and I mentioned it once again that you could still qualify with the decrease in revenue. But yeah, so whether or not you're affected is not a black and white easy answer most of the time. And then if you had a supply chain issue, so this is one of, I guess, the most highly misunderstood, things out there. It's like a lot of people just were assuming that just because the trucks that were delivering supplies to your Walmart or wherever, it might cause some shortage of office supplies or whatever, that in and of itself, that global supply chain problem isn't exactly considerate. It isn't really meeting the test of being partially suspended as a result of a government order. So it's a very narrow definition here, and they do have some other resources you could read, but essentially at the end of the day here, you got to have a government order, and you need to look at these other 3 points here, that the government order has to have to cause the supplier to suspend operations. So the person who's sending stuff to you has to have been stopped as a result of that order. Also, they further make it harder for you by saying you couldn't have obtained the supplier's goods anywhere else. So let's say you're going back to your farm example there with the cattle. If the cattle farm in Mississippi couldn't send you product, but the cattle farm in Louisiana or Texas could, and you could easily get that stuff, you had to have considered that option as well. So that could also limit you. And of course, you got to have the full or partial suspension. So yeah, so supply chain is much more tricky to qualify for, and I think a lot of people are going to be rudely, unpleasantly surprised if this stuff gets looked at by the IRS. So actual claim and credit. So once we get to the point where we have an idea that we qualify, there's a form, and it's called the 941X, and that's where you actually tell the IRS how much you want to get back. So Just in case you don't already notice, a 941 is the normal quarterly payroll tax filing. So that's what most people follow to report their Social Security, Medicare, federal withholding, and that sort of thing. 941X is what amends that to account for the credit. So here's a copy of the most recent version of the form that was updated back in April. I just highlighted a few areas that need to be, I guess, you got to pay attention to make sure you have things filled out. Because the form, there's a lot of lines in here that don't have anything to do with this particular type of credit, because this is the 941. It covers everything payroll related that you could possibly want to change. So I'm gonna apply things to make sure you address, so that you don't have a slow up in having the IRS process your refund claim. So I didn't highlight it, but obviously ID number, name, address, all that stuff's got to be there. You need to check the box here for 941, tell them which quarter you're talking about and which year, and then for the discovered errors date, I'm not sure why that's an important thing here. In our firm, we just use December 31st of 22 as our discovery date, just to put a date there, but I don't think it affects anything. Since we're claiming a refund, we want to check box 2 and then box 3. So they asked me, so we talked about that fraud situation for where the certain people sending stuff in and they didn't even file W-2s. Here's where you tell them, yes, I did my W-2s. And if you didn't, you're not going to qualify, because they did mention that thing that they are looking at that, and if you didn't file W-2s, this isn't getting processed. So they're just kicking it right out and they're going back to the people who've kind of followed the rules. So I guess file your W-2s before you file this if you didn't already do so. 5D here is just basically what we're saying, that this is not affecting any kind of withholding. It's just refundable type things. And then top of the form, make sure if you're filling this out by hand that you've got the calendar year and the particular quarter and that kind of stuff on this top row. But 18A, that's where you're going to put the non-refundable portion of the retention credit. So that's another complication. When you look at the original 941 payroll form that was filed, they want you to take out the employer's portion of Social Security and treat that as a non-refundable credit. I don't want to get too far in the weeds about what non-refundable versus refundable is. You're getting the money back if you qualify. Don't worry about it. But a number has to be here. So some portion of that, let's say you have a $10,000 refund, and when you look at your 941 form from the first quarter, let's just say $1,000 was the employer portion of Social Security. That $1,000 needs to show up here, and then on this other page in 26A, the remainder, that remaining $9,000 would show here. So basically it would total up to the full $10,000. And in retrospect, I don't understand why it's being broken out between non-refundable and refundable, because no matter what, you're going to get it all, right? So if you qualify for only $100 and you're filling that non-refundable line first, you get it. If you have more than that, you get it also as a refundable. So I don't understand why this distinction is being made, but it is there, and you do need to pay attention to it to get your returns filed in a timely manner. Also, line 30, we need to be careful of that. So they're going to ask you for the qualified wages for the credit. So here, we're not talking about the total wages. We're talking about just the wages that went into our credit calculation. So be careful of that. So initially, I think we were not filling out this line based on guidance we received from somewhere, and it turned out to be wrong and caused a few headaches down the line for some of those early filings. So make sure you put a number there. And then on the description part, you want to make sure you just verbally kind of describe what you did. So they do mention that it's required to be a detailed explanation. I have a few lines that I record. I basically say, for the quarter, we had X amount of wages. After we accounted for PPP forgiveness, owners, etc., we had a reduction of X amount, which resulted in a net qualified wage amount of X. And then I show X times whatever the credit rate was for that particular quarter is my credit, and just once again reiterate that the taxpayer requests a refund. So that's what I put in this section here. I've seen some other colleagues of mine go into much more detail in the calculation, and I don't think it's necessary. I think if you just reiterate what happened in the other pages of the form, it may help, because if you mistakenly did key something wrong, I think this verbal explanation would help anybody who's processing this get to the right answer and understand any typo you may have made earlier on, possibly. But yeah, I definitely don't recommend going overboard with the details of the calculation and putting individual employees on there and that kind of thing. I really think that would be just potentially causing more problems than it could possibly head off. And just explain how you got your number. I think you want to, on this form here, make it obvious to the person who's processing it that you didn't just pull a number off of a form. You pulled the number, you made adjustments to it for things that aren't allowable, and you net it out to a good allowable wage number for calculation of your credit. So I think if you can demonstrate that much, it should go a lot smoother. That's been our experience. These things are getting processed now and a lot faster than they were, probably by a magnitude of at least 3 months now. At one point, these things were taking 6 to 9 months. Now we're seeing 3-month turnaround. So and that's the way we've been doing it, and we've been having good success with it. So we suggest you do the same. So with that, that's I guess all of the nitty-gritty here of the updates. So, but to recap it, if you don't meet those obvious tests, those revenue tests that are really black and white and pretty easy to figure out, get some professional analysis for your eligibility. There are many frequently asked questions, and a lot of bulletins posted by IRS that are good, but what we find when we look at the things, that they're voluminous. That's just a whole bunch of stuff and a whole bunch of scenarios. They try to address every possible variation, and sometimes it just gets to be overwhelming. So you may need to just bite the bullet, talk to somebody, and pay a professional to help you. It's always good advice. And beware of the too good to be true credit mills. So like everything else, don't forget about our Katrina examples, because those people who went overboard had to pay back that money plus penalties and interest. The person who did those returns went to jail for a couple of years. So make sure you got good numbers here. And if you've got $26,000 per employee, you're definitely in the minority, and I would probably suggest at least maybe having a second look just to make sure, because that's not been on a widespread basis, that's really not been the case. And also keep in mind the fact that it could be a local order as opposed to in addition to a state order. So the federal laws don't really come into play. So it's a state-by-state basis where your review of the executive orders would start, but parishes and counties could also have restricted things a little bit more, and it could have affected your clients. So you might own a restaurant in one county, and your buddy owns a restaurant 2 parishes over in the next county, parish, whatever you want to call it. He may have qualified for more quarters than you did because his occupancy restriction may have been affected by different rules, because each one's a little bit different. So don't compare yourself to your buddy down the street, because maybe not down the street's not a good example, but your buddy from another town, because they could have been affected by different executive orders. Now, closing remarks. So if you need assistance, I would say that our firm offers a no-charge initial consultation, and based on the phone calls and meetings we've had so far, I can tell you within a very quick 10 to 15 minute tops phone call where you kind of tell me your situation, I can size that up pretty fast and tell you if there's any possibility for any credit at all, have some kind of idea what it would be, and then we could determine if it's worth moving on to paying somebody to do it for you. And the way we do it here, we don't charge a percentage of the refund. So that's another problem I'm having with these these kind of professional refund processes. They're charging 20 to 30% of the refund. So as you get into these numbers, you're seeing that a lot of these businesses are qualifying for 5-figure and 6-figure refunds, and they're paying this company $25,000, $30,000 in some cases of fees to process it. We don't do it that way. Typically, we have a base analysis fee that's determined by the size of the company, and depending on how many non-employment exits we do, there's a little bit more of an add-on charge there. But I don't think any of ours have been over $1,800 so far. So that's what you can expect if you utilize us to process this for you. And also, of course, we provide our work papers and our documents, so you can feel good about the amount you're getting back. That there's some reason for the number. It's not just pulling numbers out of there and multiplying it times the credit percentage. So if you need more information, go to our website, huffconsulting.net, and you'll see a scheduling link several places on the website. Also, you could email my assistant at info@huffconsulting.net and set up a call, or you can just email me a question. I think, I hate talking on the phone when I'm busy during the week, and I'm sure most people are the same way. So email the questions if you have some general criteria. We look at it, within a couple email questions and answers back and forth. we can accomplish the same thing as a 15-minute phone call and figure out if it's worth moving forward. So with that, good luck with everything, and yeah, reach out to us if you need any further assistance on this retention credit.